Hello and welcome to this week's episode for SPY Trader Now. I am your host. My name is Ken, and our model portfolio is up 5.63% year to date. Our stock market strength color signal is currently yellow, and we do have a put option on the board that we put on last week, and I'll show you that trade. Here at SPY Trader Now, our whole goal is with investment grade capital to beat the returns of the S&P 500 buy and hold investor. That's the goal with investment grade capital. We start the year off with $100,000 and we build the year from there. We're currently up 5.63%, but the buy and hold investor is up 7.57% year to date. So we are not accomplishing our goal. That's why we are in red and they are in black. So stay tuned if you want to see how this portfolio is going to trade in such a way that we beat that return. And that is what we show you here on this channel. We show you the trades that we actually make in order to turn this portfolio to being more profitable than the buy and hold investor. Here are some past returns for the model portfolio. Last week, the S&P 500 gained 0.6%. We'll go through the charts in much greater detail in this presentation. Here is the one trade that we made during the week, and I probably should not have made it. I can say that now in hindsight, but at the time, and I'll show you why I did this trade in a few minutes. But here's the exact trade that I took sent out on Wednesday, May 1st at 12:47 p.m. Pacific Standard Time. So at that time, I did buy one put contract. I bought the 12/19/2025 contract, 450 strike, and that premium was about $16.50 at the time of putting it on. Okay, here are the trades that we have made in 2024. If you want to see all of my trades going back for the last 3 years, you can head over to this link. It will be down in the description down below. There are some yellow cells here indicating open trades. These haven't been closed out yet. These are current open positions. I just put in Friday's date, or today's date rather, and I just put that in just so that we could have a measure of what the current price is for the S&P, for SPY, and also for our current option. We're down negative $94 on the option that we purchased for $1,650. So that's where we stand with those positions. But here's where our portfolio is currently valued at, starting the year off at $100,000. If you want to see how I do this throughout the year, go ahead, hit that like button down for me right now, subscribe to my channel, and ring that bell to be notified when I post a new video. Here is the equity curve for our model portfolio 2024 year to date. This is the equity curve of the S&P 500 buy and hold investor 2024 year to date. And on a percentage basis, here are the two portfolios combined. You can see where the S&P 500 really was starting to get away from me, and I was not taking on enough leverage during this time frame. And that is when the S&P 500 just completely smoked me out. But due to their strong correction and the way that I was positioned, I was making some money while they were losing money. And now the portfolios are fairly neck and neck. Although, because I took on that put position, that put me behind the curve another $94. So our goal is for our model portfolio to be above this pink portfolio by the end of the calendar year. So we have plenty of space in order to make all of this happen. And I can tell you that the S&P 500 is going to be in for a little bit of a wild ride on this election year. Now we are looking at the Fed Chair, Jerome Powell. Last week was the announcement on May 1st. What did the Fed do? The Fed holds the rates. And I've got some pretty good slides coming up about this interest rate hold. But basically, the committee decided to maintain the target for the federal funds rate at 5.25 to 5.5%. So they are on a hold. And let me show you on the next slide. All right, so the Federal Reserve press release, we know that they left interest rates unchanged for the 6th straight meeting and suggested that rates would stay high for longer. The Fed stands at a complicated economic juncture. After months of rapid cooling, inflation has proved surprisingly sticky in early 2024. The Fed's preferred inflation index has made little progress since December, and although it is down sharply from 7.1% highs in 2022, it's currently at 2.7%, which is still well above the Fed's 2% goal. That calls into question how soon and how much officials will be able to lower interest rates. Now, despite the Fed's earlier this year penciling in 3 rate cuts in 2024, Wall Street investors now forecast just a single rate cut. Now, in addition to that, you also have, as part of the minutes, beginning in June, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on Treasury securities from $60 billion to $25 billion. So what does that mean? This means that the Fed will allow fewer Treasury securities to mature and not be replaced each month, slowing the overall reduction of its balance sheet. So what does that mean? Basically, this is when you reduce the balance sheet, that is quantitative tightening, okay? Quantitative easing, if this was the opposite, would be with the Fed buying more bonds. In this case, they're letting the bonds run off, not rebuying them, so they're running their balance sheet down. And that is a form of quantitative tightening. But what are they doing? They're changing their form of quantitative tightening from, instead of letting the balance sheet run off by $60 billion, they're letting it run off by $25 billion, which is each month. So this is a form of quantitative tightening easing, which I know this is very highly, it's, you know, seems like I'm doing a little bit of double speak on you, but what basically this is what is ultimately happening here. We still have quantitative tightening, which, by the way, the market does not like quantitative tightening. The stock market likes quantitative easing. But if you're going to have quantitative tightening, which the stock market doesn't like, it's going to like it a lot better if it's easing the amount from $60 billion to $25 billion of the quantitative tightening. So it's going to like that better. So from now until the next Fed announcement, which is on June 12th, you're going to be in this position where you're going to have quantitative tightening is easing, which the market should like that. Now we are looking at things from the presidential election cycle theory, which states that depending upon the year of the election, you have historical rates of return for the S&P 500 as well as the NASDAQ 100. Currently, President Joe Biden is in his 4th year of his term. Historically, the S&P 500 averages 6.7% on annualized return in the S&P 500. Currently, the S&P 500 buy and hold investor is up 7.57. So they're above this by about a percentage point, giving plenty of room for this market to bounce around between now and the end of the year. Now we are looking at things from the bond market outlook. In the bond market, which by the way is very smart and 4 times the size of the stock market, is saying stay out of the stock market because you have an inverted yield curve and you also have rising interest rates. But let's see what just happened. Check this out on the 2-year yield. So I monitor the 91-day, the 2-year, and the 10-year. Now we're inverted because the short-term 91-day yield has a higher interest rate than the yield on the 2 and 10-year yield. These need to be higher than this number here in the 91-day yield. But the 2-year yield, which was in the 4s forever, is now jumping into the 5s for the first time. Still below this 91-day yield, but it's at least in the same realm as the same number as the yield for the 91-day and the 2 years. So at least they've got the 5 in the front of it there. But at this pace, it's possible that we're going to have a corrective yield curve this year in 2024. It's got to normalize eventually. This is an abnormal situation. And normally speaking, when you do normalize 1 to 4 months after that, you're going to have the stock market's going to notice that, and of course economically you're going to notice that. These are usually precursors. All inverted yield curves are precursors to recessions. So all of this is in the pipeline. The only thing is when is this going to happen? The Fed is trying to engineer a soft landing, and you have interest rates here, especially the 10-year yield, which is fighting him the entire way. So he's trying to perform this balance of what he's doing with interest rates in an effort to engineer the best soft landing for the country and for the stock market. Now we are looking at things from the CNN Business Fear and Greed Index. This is Warren Buffett, the Oracle of Omaha, one of the, if not the best stock market investor of all times. And here you've got your Fear and Greed Index, and we are in fear. Last week we were at 42, and now we've dropped slightly down. We are in 40, but we're still in fear. Now we are looking at a seasonality outlook for the S&P 500. Currently, we are in the month of May. Going back 20 years, now I want you to remember this because the next slide I'm going to show you the 10 going out 10 years and 5 years. There's a 75% probability in the month of May that you're going to close the month higher than when you opened the month, okay? Currently, we are up 1.85%. We are accomplishing this goal. We're in the 75 percentile, but the month just started. So we got 3 more weeks or so to go for this month to be closed out. But it's highly probable that you're going to close out the month higher than when this bar opened the month, which is right here where my cursor is. Now, going back only 10 years, there is a 90% probability you're going to close higher. Going back only 5 years, there is a 100% probability that you're going to close higher than when you opened. Well, these odds favor being long. Hence, my put is not doing me any favors right now. Hence, I need to try to close that out. Now we are looking at things from a long-term outlook. This is a 20-year monthly chart of the S&P 500. Long-term bull run here, and you can see that we have bottomed and we are now advancing here on the chart. So everything is positive from a long-term outlook. Now we are looking at a weekly intermediate term 5-year candlestick chart. Now we had a 10% correction here. I copied and pasted this rectangle over to our current condition where we reached the top and started to come down. Now I thought we would potentially have a 10% correction, and we still may. This is all going to stay in place unless we start going above this high, the recent highs that we made. If we start making new highs here, then that negates this entire 10% pullback, and it's off. The race is on, and we continue this advancement, and we need to be long this market. But that's not the case right now, so we are monitoring all of this. But it looks like from a weekly standpoint, slow stochastics has definitely softened its momentum, and we are still below the signal line on the MACD. So let's see how this plays out. Now we're looking at this on a 6-month daily candlestick chart. You can really see the candlesticks nicely. Now here on this arrow right here, that's when I bought one long put. I bought a put because this was a rejection candle. I saw the market had a nice big red candle on the day before, then the market tried to advance. It got rejected at this purple line here, which is the 21-day moving average. And I thought that we were going to fall back down into this trading range. That did not happen. The very next day, we bounced off of the top of this trading range and went up. So in retrospect, instead of buying a put, I should have bought a call, but I didn't do that. Now we are at the 50-day moving average right now. This green line here is the 50-day moving average, and we are smack dab at it. Bottom line is below the 50, not good. Above the 50, good. And right now we're right at the 50. Notice the last time we came right at the 50, we got rejected. So at this point in time, I actually think we are going to surpass and go above the 50 with all that information, especially that strong seasonality I showed you. But there's a gap here between Thursday and Friday. It gapped up. This is my hope. I'm hoping that the market will soften over the next few days, come down and tag this red line, which is filling the gap. When it fills the gap, I'm going to close out my put. I'm going to change that to a call, and I think we're going to come back up and at least tag this 515 number. This is what I'm thinking is going to happen, but of course I'm just one person here. But look at the way that your MACD is set up. It's set up in a nice positive configuration. Same thing with the slow stochastic. Your histogram here is showing you this market does want to pull forward. This wants to continue on. So all I want to do is have it fill the gap so I can close out my $94 loss at a little bit less than a $94 loss, take on a call, and let that come back up and kiss this 515 and profit off of that. Well, so let's see what happens over the next few days of trading. Now we're looking at a ratio chart of the NASDAQ 100 against the S&P 500. Now here you can see that we are in this trading range, and we are right there at the smack dab, right almost at the top of that trading range. Now in dark blue is the S&P 500. Now you'll notice that the last time the ratio chart fell down from the top of this range to the bottom, the S&P 500, if you carry that up, took a nice good drop during that time frame. I'm hoping that happens again over the next few days, because then I can buy to close my put position either at break even or a slight profit, then take on a long, and then as this goes in the opposite direction, capture those gains. So let's see how this plays out. This is another ratio chart, but there's nothing to really speak of this week because there's not much going on here. So we're just going to keep this on, but nothing to speak of. Now we are looking at the VIX Volatility Fear Index. I've got three ranges. Below this green line is your ultra low range. In between this green line and this green line is your low range. Above this green line is the upper range, where you lose most of your money. The market came from the upper range all the way down into the ultra low range. And even though we were developing this trading pattern, we've dropped even below that. So I should actually move this line here down to between here and here. But we have a nice big red candle here. That means fear is being sucked out of this market. And when you're in this low range, the market advances like it did. See here, you're in this low range this entire time. The market just trucks on. So this all just happened, or we just came down from this low range to the ultra low range. That's recently happening and coming out of this channel right there. That just happened on the last candle Friday. Now we are looking at the Thinkorswim platform for the S&P 500. This is a 5-year weekly chart, and you have standard deviations. +2, -2 in gold, +1, -1 in pink, standard regression line in dashed green. And currently, we did not reach the +1. We started to come down, and we are currently at 0.5 standard deviation. So we are monitoring this. Now we are looking at the same chart, but instead of going back 5 years, it's only 1 year daily. So here you can see that we are right at the regression line and right at the 50. Now we're looking at the same chart, but instead of going back 1 year, we're only going back 6 months. And on this one, the standard deviation takes you to negative 0.6. So we've got a buy zone down here and a sell zone way up here, which we haven't reached in quite a while. Now, here's a spreadsheet that I developed, and I wanted to see what was happening with asset classes and the 11 S&P 500 sectors. And we monitor this. Now, I recently changed my algorithm up here, or the formula for how I derive at this information, and I basically changed the trading above and below the 50-day moving average to have better differential. Now I can go from -2 all the way to +2. That's 4 differential, which is on this for this formula, so it's quite significant of a change. You know, cementing in what I was telling you. Below the 50-day bad, above the 50-day good. And that's why this number really represents that. Now, I do want to tell you, because I was looking at the charts, on the NASDAQ 100 and the small cap symbol IWM, these ones here are just under the 50. Once they bounce above the 50, so a little bit of strength up in this market can dramatically change this number depending upon whether you're below or above the 50. So we're hovering right around the 50 and just below it on some of this, and you can see all the -2s we have. So this is one of the reasons why you've got this lower number. Same thing over here with the 11 sectors. The 11 sectors did drop more. Last week it was at 58. This week it's at 41. So we are in the yellow section right here. I guess I should have made that yellow instead of red. I put it red because we went down from last week. And I put this one as green because it went up from last week on the asset classes. Now this tells you what strong sectors you have: consumer staples, industrials, utilities, delivering nice 5 and 6 numbers. Over here, your 5s and 6s are the S&P 500, gold, silver, and emerging markets, and world markets excluding the United States. Here's all your symbols. Now we are looking at a 1-year chart of the 10-year bond yields. We are in a trading range here and here. We've reached the top of that trading range and we are coming down, which the stock market does like. So as long as this comes down, the stock market will continue to advance. And you can see that the momentum on the MACD and the slow stochastics is coming down, giving further weight that you are going to come down this way, which isn't going to help me closing out my put anytime soon. All right, I have just given you guys a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? Well, as of May 4th, 2024, the market summation, according to me, Ken, your friendly host with SPY Trader Now, I was premature on taking in that put. I do want to exit it as soon as possible on some level of a pullback, which I'm hoping to get this week. Luckily, I am only upside down $94 currently in the put. The month of May is poised to have a positive return, and we should be long right now. I showed you all that information in this video. I hope you've gotten some valuable information out of this video. If you have not done so already, go ahead and hit that like button, subscribe to my channel, and ring that bell. I thank you and wish you good trading.